All right, so in this next video, we're going to go ahead and practice one more type of bond. And so we did face value and we did discount in the previous videos. And now we're going to do one more type. So going back to the problem, Archer Spy Supplies issues a $70,000 of a 10-year 9% bond payable on January 1st, 2018. They pay interest each January 1st and July 1st, so that's semi-annual payments, and they amortize discount or premium by using the straight line amortization method. And the company can issue the bonds under various conditions. So in the previous video, part one, we did face value, and then in part two, we did discount. And so now we're going to practice one other type. So just to get you okay to understand why it is this type, let's just ask the question. And so what type of bond is one issued at 103? So we're going to journalize an entry for a bond issued at 103. So think of 103 as a percentage. So the bond is issued at 103%, and that's more than 100%. So that type of bond is a premium. Okay, and you should have read a little bit already on this to understand, but as a reminder, just an easy conclusion, a bond trades at a premium when an interest rate is more than the prevailing interest rates. So that 9% here is actually more than, it's a higher percent than what's out there in the market. Whatever the investor is able to get out there in the market, it's less than the 9%. And so this bond is actually, they're getting higher percent of interest payments. The individuals are letting Archer Spy Supplies borrow this money. And so the incentive of this is that they're going to give more cash to Archer Spy Supplies. Okay, and so as we're going through this, let's go ahead and do some easy math. This is where it gets easy for us. We have here the bond face value of 70,000. Let's get rid of this bold. All right, at 103%, so that's 1.03. And then that equals 72,100. That is going to be the cash received. All right, so Archer Spy Supplies is going to receive 72,100, more than the bond's face amount, because that interest rate of 9% is more than, it's higher than what out there in the market the interest rate is. But the note due at maturity, as a reminder, just like with the discount, is still the face value of 70,000. And so if we were to do a little subtraction, 72,100 minus 70,000, that tells us the difference of 2,100 is the premium. That's the premium on bonds payable. So look here, we have our journal entry already laid out for us here. Let's actually do okay, so we can say Archer Spy Supplies, they got more cash than the face value, so they got 72,100. And we can skip that line for a second, and we can say the bond is payable, the amounts due, and still at this face value. So I have higher debits than credits. So if I were to do my plug, I would know I need a credit for 2,100. So I can say, oh, okay, the premium on bonds payable must be a credit balance. All right. If you remember the discount on bonds payable in the previous video, that had a debit balance. Here we are, this one. All right. So we're almost there. we got one more journal entry. We're going to journalize the semi-annual interest when the bonds are issued at 103. So just like in the previous videos, we're going to calculate that interest amount, that semi-annual amount, and that's going to be our cash payment. So that's going to be the 70,000 principal times rate times time, so times the 0.09, and then it was 6 months out of 12. And so we did this a bunch of times in the other video, but let's just write it out for ourselves. And so that is the semi-annual amount, and let's label this as the cash payment. We're laying out what we have for our journal entries. All right, so now we're going to do the amortization of the bonds payable, of the premium on bonds payable. So we're going to amortize this 2,100. We're going to slowly chip away at that with our payments. And so we have it for 10 years. So remember, we're making it 10 years. This bond's for 10 years, but we're making 2 payments a year. So how many payments are we making? 10 times 2. So each year it's 2 payments. So we're making 20, a total of 20 payments. All right. So 10 years, let's write it out, times 2 times a year. So that is, what is it, semi-annual. And that equals 20 payments then. All right. That way we remember why. So now we have the 2,000, oh, what happened there? 2,100, all right, divided by 20 payments, all right, and that is 105. So each year we're going to amortize that credit balance of 2,100. We're going to chip away at it with a debit for 105. All right, so that is my, let's do this. That is my premium. That's my amortization of the premium. All right. So we have, what did I write? Cash payable. That's the cash payment. There we go. So we have cash. We have my premium on bonds payable. All right. And what else do we have? Oh, we have interest expense. So in this case, so this is a credit. This is going to be a debit. Right? We're going to do a debit to chip away at this credit balance up here. And so our interest expense is different than when we did the discount. When we did the discount, we had more interest expense because we got to add that additional amortization. Well, in this case, we're going to subtract. So we're going to have a lower interest expense. And yes, you could just do it as a plug, and you'll see in a minute that it can work that way as well. All right, so let's go ahead and write this out. We can skip that one if you want. Let's just write a placeholder for it. Even though we did the math over there, but we did the calculation for bonds payable. In case you didn't know, if you subtract or add, let's just show you that it can work this way. So we know that we're going to chip away at that credit balance with a debit, and then we know we're going to pay out cash for the 3,150. And so I do need a debit, but it's going to be less, a lower amount, we can see. And so that is 3045. And that is the interest expense. So you could have plugged this one if you didn't know. I'll put this in here to show you that you could have just done that way to figure it out, and that's fine. Okay, so let's do this part here, this little analysis. I talked about it a bunch already, but let's just go ahead and do it just in case, just to make sure you're good. Oh, what happened there? Let's pause. Okay, that should be fixed. My screen was doing wacky things. But so we just concept check here for this last part of understanding the interest expense account. We already talked about it a couple times between the discount and the premium, but let's talk about it again. So the blank results in the most interest expense. Well, we can see we lowered interest expense just now for the premium. And in the previous video, we did an addition. And so our interest expense was the most with the discount at 92. So we can write that in. The discount price of 92 resulted in the most interest expense. And so the discount must be amortized over the life of the bond, resulting in an interest expense amount greater than the amount of interest actually paid. Because our cash payment, when we're looking at the discount amount, was only $3,150, but we got to do $3,430 extra. So concept check there on the discount with the difference between that and the premium. So that is it. Those are the 3 different types of videos in all 3 parts of the video for chapter 12.